Hi, I'm Al from the Money Study, bringing you another episode in our Take 10 challenge, and we're up to number 43, and we're going to talk about these things called ETFs, Exchange Traded Funds. Before we start, there's the disclaimer: facts, figures, information, it is not advice. So, you'll hear the term probably ETF, far more common than ETP, but I just need to explain that an ETP is the family name that includes these things we're going to talk about. ETFs also includes managed funds and other products, which we'll talk about later on. So, but we're going to focus on ETFs. But if you see the name ETP, it literally just means it's the umbrella. It's the family name of which it's part, or ETFs are part of. Now, these products, they are bought and sold on the share market, just like you would buying your Commonwealth Bank shares. You just open up an account and you want to buy one of these things, you click the button to say you want to buy it, and you can click the button to say you don't want it any longer. Now, the whole point of these things is the fact that what you're trying to do here is to mimic effectively a particular market. Now, generally speaking, what these products do is to track the performance of a particular index. Now, an index represents a particular market. So let's talk the ASX 200, the Australian Stock Exchange is what ASX stands for, the Australian Stock Exchange 200. That's the top 200 companies in the ratio that they exist, from the biggest down to the smallest in that top 200. And as we know, they are still big companies, even down at number 200, they're still big companies. And we sort of add up all their share price today, and then add up all their share prices tomorrow. And if they went up by 1.4%, the index went up by 1.4%. And that's how we can sort of track what the overall market is doing. Now, when I talk about the market, we could be talking about the top 20 companies, or the top 50 companies, top 100, top 200, top 500, and so it goes on. And it's not necessarily Australian market. It could be the top companies in America or UK or European countries or whatever. And so these companies pick on a particular group of assets, be them shares, but it could also be currencies. They can actually track the difference between different currencies, or it could be commodities like gold or oil or so forth. So these products are literally trying to capture the overall movement in a group of things that are similar from that point of view. Okay, so that's what they're all about. Now, the difference, however, with an ETP or an ETF is the fact that these things are what they call open-ended. Now, we've been talking about in previous sessions about the LICs and shares being closed, meaning there's a certain number of shares available in Commonwealth Bank, certain number of shares and so forth in LICs and so forth. But with an ETP, these things are created by a provider. So there's a person out there who's basically offering to sell an ETF to you. So they've got an ETF, they're going to sell it to you. You buy it, and then another person comes along, they'll create another one. So what they are effectively doing, let's imagine it's an ETF of the ASX 20. So in theory, what they're doing is they are buying the shares of those top 20 companies in the way that they represented, and they create this parcel of shares which they sell to you. Joe Bloggs comes along and he wants one too, so they go out and effectively buying the shares of those other companies again for the next person, and so it goes on. So basically, the more people that want them, the more there are of them. And of course, if everyone wants to get out, then there's less of them. There's just people as they basically getting rid. So they're increasing and decreasing depending on demand and supply. So it's because of this, it really means that these things are quite accurate in their value. Now, when we were talking about LICs yesterday, it was a case that there's performance fees and things that have to be taken into account, and it can be the fact that the value of the underlying companies isn't the value, added all up, is not the value of your share in your LIC. But in this particular case, they literally, it's the value of the ETF pretty well equates to, the value of all the underlying shares in that particular ETF. So if you were to add up all the share prices and so forth of the top 20 companies and compare it to the ETF, and then the ETF, and measure those tomorrow, and if there's been a movement in the market in those top 20, the difference between owning the top 20 and owning the ETF, the difference would be very, very, very similar. Okay, so that's the whole benefit here. We're getting the benefit of what the market is doing, but we're doing it simply by purchasing a group. So as I keep on coming back to this whole problem of where do we start? How do we start if I don't know what company to buy? Whereas if we can buy something like an ETF, which effectively is a parcel of shares, we can start off our portfolio quite diversified, Of course, in the Australian market, the top 20 companies, there's a lot, the major banks, all four of them are in that top 20. So we got a fair bit of our money in banks, and of course, the value of companies like Rio and BHP also make up a big chunk. So it's not as diversified in the scheme that we've got a little bit of everything. It is sort of weighted towards some of these really big companies. But by the same token, we are indeed, because we've got in the top 20, say Telstra, and we've got Woolworths, which is a retail company. So we are, if you were to buy an ETF of the top 20, you're certainly getting a reasonable range, but a top 200 ETF, wow, now we're really sort of spreading our money across a lot of different things there. Now, on the ASX website, I've just done a screenshot of, there's a list of the hundreds of ETFs that are available. And of course, this is where it gets tough again in regard that, okay, which ETF do I buy? And we'll be talking about this in upcoming sessions. But it does come down to the fact that you can see here that there's a lot of different companies basically generating the same thing. So we've got an ASX 200 index ETF and put out by Beta Shares, and then there's also ones here by Legg Mason, and there's ones here by iShares and so forth. So you can see that you can have the same thing put out by different companies. And so you've then got to look at perhaps, this MER is the management expense ratio. So this is basically what it's costing to them to put this thing together. And this is a percentage. So 0.85, so it's less than 1% is the cost to run this thing. So if effectively you're losing 0.85 of 1% in effectively the management to run that ETF. And of course, 0.39 sounds a lot better. But of course, then you've got to see, because mind you, sorry, that's a small caps one. So you've got to compare, apples with apples. And you can see here two different companies providing exactly the same thing. Oh, they just happen to have the same, the same management fees, and so it goes on. But you see, it comes down to they can be very good for starting your portfolio, but they can also be very good to add to portfolios, depending on some of these ETFs can be quite focused as to what they are buying. Just imagine you've already got some blue chip shares. You've got your Telstras, you've got your Woolworths, you've got your banks, you've got miners and so forth, and you're going, well, now what would I mind doing now is to get some little companies, so you might turn around and buy the small companies there, or you may say, well, okay, I've got all the big ones. How about I look at this one, which is it's effectively the Australian market, but it doesn't buy the top 20. So you're buying everything else. you've already got those, you might have those, so you can turn around and buy everything else just to pad it out, and so it goes on. Because then there's an ASX 100, a 200, a 20, and so it goes on. And this list just goes on and on and on and on and on and on. So I say it can be confusing to what we're going to buy, but I'll certainly show you a way to eliminate that problem in future sessions here. But it's become a very, very popular method of buying, getting into your investing. But there's a few issues that you need to understand. If you go to a financial planner, for instance, and you want to invest your money, then they recommend you, generally speaking, that you buy what's called a managed fund, and that's run by a fund manager who's going out and buying shares and so forth. But those things you don't buy them on the stock exchange. You buy them through particular companies, and effectively financial planners can get them for you. So, but if you're going to buy them on the stock exchange, and we're buying these funds on the stock exchange, just like you buy a share, then every time you buy and every time you sell, there is a cost. There is a cost. So we've got to be careful that we're not buying every second day or selling every second day, because we're going to get transaction costs that could indeed come into play. You don't get those brokerage costs effectively with managed funds, but they've got other issues which we'll talk about in another session here. So it also comes down to the fact that when we looked at that previous slide there, some of these ETFs have been around for quite a few years. Others have only been, very new. I must admit, I'm not interested, quite frankly, in a brand new ETF. I want to see a bit of history. I want to see a lot of people interested in it. I don't want to be the only idiot to go out and buy a brand new one if there's no one else that wants to buy it off me later on. So I'm looking at big ones that there is a lot of trade going on. A lot of people are buying and selling these on a daily basis, so they're popular. So it's easy to get in and out. And as I say, probably the longer they've been around, it gives you a bit of history of what they've been doing. And then, of course, who's the company running it? It's got to be a big name company, not some new fly-by-nighter. They might turn into be a good company, but I must admit I'm not interested until they've got a bit of history there. The amount of money going into these ETFs has been growing pretty much exponentially due to the fact that they are a very convenient way of doing it, but they have certainly been promoted by many, many books. There's a lot of books out there talking about wealth creation, and that they like these ETFs because of the simplicity and the low cost. Now, in Australia, there's a book by Scott Pape. He's written this book called The Barefoot Investor, probably the most popular finance book in Australia currently, and been around for a while. It's not a bad book. I think there are better books, to be quite frank, but it's not bad. But it's certainly easy, But the long and the short of it is, he loves these things, and even if you want to know more, getting hold of that book and just reading the section on that is probably not a bad way of doing it, because his explanation is nice. It's simple. He explains why and why it's good and the convenience and so forth. But the more people buy the book, the more people are buying the ETFs. Now, that's got some pros and it's got some cons there, because you see, what's going on here is that if every man and his dog buys an ETF, and let's say they buy the ASX 100, they bought the ETF that's basically a parcel of all the top 100 companies in Australia. Now, because everybody's putting money into it, and then the ETF is effectively making the share price of all of those 100 companies, because they've been bought to create the ETF, it's pushing up their share price. So the pure fact that they are in the top 100 means that their prices are going up, possibly not because they're a great company, but because they managed to make it in the top 100, and they're probably staying in the top 100 because the ETF is being purchased by more and more people, meaning that share is being bought by more and more people because of in the index. So we're sort of artificially, perhaps, supporting underperformers. Now, it's hard to know whether we are or we're not. Does the company really deserve to be there? And this is where analysts need to sort of really look at, what the company is really doing. But it's really hard to argue if the share price is going up to not buy it, because the share price continues to grow because it's part of the ETFs. So it's a bit of like a catch-22 sort of scenario there. It's going to be fascinating to see if we then get some sort of a big downturn as to how these things really do perform. Because I don't expect to understand everything here, but there are ETFs that can be completely diversified. This particular ETF is what's called a diversified conservative fund, meaning it's got a bit of everything. It's got some shares, it's got some commodities, it's got some cash, fixed interest, all inside the ETF. So it's got the top shares, the top bonds, the top, whatever it might be. And therefore, it should be a reasonably conservative sort of thing to buy, because it's got good diversification and it's got some lower risk type things in there. But it's an ETF. So even though it's mimicking these things and actually is buying those things, it still comes down to the fact that when things go wrong, the thing has to be sold. You've got to sell it. And if you're buying it when the market's going down quickly, then, what price are you indeed going to get for it? Now, I took a snapshot here of looking at what happened during COVID on this conservative fund, and up here the price was just moving tiny bit every day, and that's what I was expecting to see out of one of these things. But then COVID hit nerves, and all of a sudden, and kerplunk, it went down to here, and then with all of a sudden, people thought, oh, that's a bit too low, perhaps we should buy that thing again. And there was a bit of a surge, and all of a sudden it got up to here before people started taking some profits, and down it went again. But this thing moved by 17% effectively over a period here of a few days. And something conservative shouldn't move that much. So if you had the underlying shares and the underlying bonds, and you owned all these things individually, they would not vary by so much. But because you've got a parcel that literally has got a price that someone effectively, its value is changing dramatically, this particular ETF, there's not a lot of people, because it was relatively new at the time. This is an older slide, obviously, because it was COVID. There weren't that many people in it. And therefore, when things went wrong, then the prices got way out of whack compared to what it was actually worth. Okay, so there's a few things there that we need to be aware of that a lot of people don't sort of mention when they rave on about how great ETFs are. But I think a big ETF, a common one that's traded consistently, and we'll talk about these a little bit more coming up, then we eliminate a lot of this problem. But don't jump into some wild new fancy ETF because it sounds like, oh, that's great because it's tracking, lithium or whatever, AI or something like that. You think, well, that'll be great. If it's only new, and there's not a lot of people who've jumped on board as yet. Okay, so be a little bit careful. Okay, but we'll talk about how we find these things in another session for you. Look forward to you joining me again.